My wealth is due to a combination of living in the United States, lucky genes, and compound interest. Warren Buffett. Have you ever wondered how he, a young man who started by selling newspapers, became one of the richest men in the world? The answer doesn't lie in extravagant schemes or complex strategies. It lies in something so simple yet incredibly powerful: compound interest. But what exactly is compound interest? And how can it turn seemingly small investments into massive fortunes over time? Today, we will explore how this invisible force works, how Warren used it to build his wealth, and most importantly, how you can also apply this principle to your financial life. Imagine planting a tree. At first it's small, but over the years it grows, bears fruit and spreads seeds that generate new trees. Compound interest works exactly the same way. The money you invest starts earning returns, and those returns begin to generate new returns, creating an exponential growth cycle. Buffett started investing at 11 years old. It wasn't luck that made him a billionaire, but the discipline of reinvesting his profits and the time that allowed compound interest to do its work. He often says that time is the friend of wonderful businesses, and that is exactly what we are going to break down here. Now, you might be wondering, okay, but does this concept work for me, someone who doesn't have millions to invest? The answer is a resounding yes. Compound interest is not a privilege of the wealthy. It is available to anyone willing to start early, be consistent, and let time work its magic. Get ready to change the way you view money. The power of compound interest can be your greatest ally in building wealth. Let's uncover this simple secret together, one that can transform your financial life forever. To truly understand the power of compound interest, it's essential to grasp the basic concept behind it. Simply put, compound interest is interest on interest. This means that the money you invest earns returns, and those returns also start generating more returns, creating a snowball effect over time. Imagine you invest 100 reais with a 10% annual return rate. At the end of the first year, you will have 110 reais. In the second year, this amount grows to 121 reais because you're earning interest not only on the initial 100 reais, but also on the 10 reais earned in the first year. Over time, this growth becomes exponential. Now let's put this into perspective with Buffett himself. He started investing at 11 years old, buying shares of City's Service. Although he experienced ups and downs early on, he quickly learned the importance of reinvesting profits. He wasn't chasing quick gains. He focused on steady and sustainable growth over time. This mindset, aligned with the power of compound interest, was crucial to building his fortune. One of his most important principles is a long-term mindset. He often says that the stock market is a device for transferring money from the impatient to the patient. This means that those who have the patience to let their investments mature reap much greater rewards. The rush to achieve quick profits can be an obstacle to real wealth growth. Imagine a situation with two different people. Person A starts investing 500 reais per month at 20 years old, with an average annual return rate of 10%. Meanwhile, person B starts investing the same amount, but only at 30 years old, with the same return rate. By the time they reach 60 years old, person A will have accumulated approximately 6 million reais, while person B will have around 2,300,000 reais. The difference? Just a 10-year head start. Person A's final amount is nearly 3 times greater simply because they started earlier. This is the power of time combined with compound interest. Warren also emphasizes the importance of investing in solid and understandable businesses. He prefers companies with simple yet robust business models that can grow consistently. A great example of this is Coca-Cola, in which he invested heavily. Coca-Cola not only generates consistent profits, but also reinvests those profits wisely, increasing value for shareholders. Another crucial point is avoiding speculation. Buffett has never been a fan of trends or fashionable investments. He prefers assets with solid fundamentals, even if they don't promise spectacular short-term returns. His focus has always been on sustainable growth, where compound interest can fully work its magic. For those just starting to invest, the strategy should be simple. Start as early as possible, invest regularly, and be patient. Even if the initial amount is small, the key is to remain consistent. Warren didn't become a billionaire overnight. His wealth began to grow more aggressively after the age of 50, precisely because he allowed compound interest to work for decades. A practical way to apply this is by investing in dividend-paying assets and reinvesting them. Solid companies that distribute profits to shareholders allow you to reinvest those earnings, enhancing the effect of compound interest. Imagine receiving dividends and using that money to buy more shares of the same company. This constant cycle of reinvestment amplifies the growth of your wealth. To make this process even easier, there are automatic investments like index funds and dividend reinvestment plans that handle this work without you needing to worry. This way, you can put your money to work for you while focusing on other areas of your life. Buffett perfectly sums up this philosophy with a simple phrase: someone is sitting in the shade today because someone planted a tree a long time ago. This thought perfectly captures the importance of starting early and allowing time and compound interest to do their work. He has a unique approach to dealing with the market. He doesn't get carried away by collective euphoria or panic. In fact, he sees economic crises as great opportunities. As he himself says, "Be fearful when others are greedy, and be greedy when others are fearful." This philosophy is essential for making the most of the power of compound interest. Why? Because during crises, many solid companies' stocks become undervalued. Buffett views these moments as a clearance sale of quality assets. Buying valuable companies at low prices accelerates investment growth when the market recovers, allowing compound interest to act on a larger capital base. A classic example was during the 2008 financial crisis. While many investors fled the market, Warren made significant investments in companies like Goldman Sachs and General Electric. He secured advantageous purchasing conditions, ensuring consistent returns in the following years. This move was only possible because he had patience, discipline, and liquidity to act. Another crucial point in his strategy is his ability to assess undervalued stocks. He follows the concept of a margin of safety introduced by his mentor, Benjamin Graham. This means buying assets for less than they are truly worth, creating protection against misjudgments or market fluctuations. By investing with a margin of safety, he reduces risks and enhances gains, maximizing the impact of compound interest. To understand how to apply this in practice, imagine you're interested in buying shares of a company valued at 100 Rs per share. After thorough analysis, you believe this company is worth 150 Rs per share, but the market is offering it for 80 Rs. This is an opportunity with a margin of safety. By buying at a low price and holding the stock for years, you benefit not only from its natural appreciation, but also from the exponential growth of compound interest. Another vital aspect of his strategy is consistency. He doesn't aim to multiply capital quickly. His focus is on continuous and predictable growth. Buffett compares investing to planting a seed and nurturing it until it becomes a strong tree. This requires patience and discipline, virtues that are increasingly rare in today's fast-paced world. But how can one maintain this discipline? Warren avoids market distractions like short-term speculation and economic forecasts. He focuses on companies' actual performance and their fundamentals. For him, Time in the market is more important than trying to predict short-term movements. This mindset is essential for compound interest to have enough time to operate at full strength. A practical lesson we can take from this is the importance of maintaining long-term investments, even during crises. Many investors sell their positions during market downturns out of fear of losing money. However, those who remain calm and continue investing or even increase their contributions during these times achieve much better results in the future. He knows the market always recovers, and it's during this recovery that compound interest reveals its true power. Another clear example of this was Berkshire Hathaway's investment in Apple. Initially, Buffett avoided the technology sector, but upon realizing that Apple was more of a consumer company with an extremely loyal customer base, he invested heavily. The return was extraordinary, and today Apple represents a significant portion of Berkshire's portfolio. This investment not only grew in value, but also began paying dividends that were reinvested, further amplifying the effect of compound interest. In addition, he values simplicity in investing. He believes you don't need complex strategies or insider information to succeed. The secret lies in understanding the business you're investing in, buying at a fair price, and letting time do its work. As he says, the simplest investments are usually the best. For ordinary investors, this means focusing on products like index funds, which track market performance and allow for steady growth at a low cost. The average investor can achieve excellent returns simply by being consistent and patient, without needing to beat the market. Finally, Buffett always emphasizes the importance of investing in yourself. He believes the best investment anyone can make is in their own financial education. Understanding how money works and how compound interest operates can radically change the financial path of anyone's life. His strategy is simple yet powerful. Start early and invest regularly. Take advantage of crises to buy quality assets. Be patient and consistent. Avoid speculation and stay focused on the long term. Reinvest profits and dividends whenever possible. Throughout this video, we explored how Warren built his fortune by consistently applying the power of compound interest. We saw that this simple concept, letting money work for you over time, was fundamental in turning modest investments into one of the world's greatest fortunes. He didn't take shortcuts or chase quick profits. He followed solid principles, investing early, being patient, seizing opportunities during crises, and constantly reinvesting profits. These strategies aren't exclusive to billionaires or financial experts. They are within reach of anyone willing to start with discipline and consistency. And as Buffett wisely said, someone is sitting in the shade today because someone planted a tree a long time ago. So start planting your financial tree today. The best time to start was yesterday. The second best time is now. If you enjoyed these lessons and want to learn more about achieving financial success inspired by great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that can transform your perspective on finance and investing. See you in the next video.